Hello everyone, welcome to the Graphics channel. To succeed in the financial markets, reading charts correctly is essential. Double top and double bottom patterns are among the most reliable ways to spot trend reversals early, but most traders only see these as shapes without developing a strategy. In this video, I'll walk you step by step through double top and double bottom from scratch. We'll strengthen your trading strategy with target price, stop loss, risk-reward ratio, and possible scenarios. If you're ready, let's begin right after the intro. Double top. The double top pattern forms at the end of an uptrend. The two peaks are at roughly the same level, with only minor differences between them. The neckline in the middle is the confirmation point of the reversal. The first peak usually comes with high volume, while the second peak forms with lower volume. This shows that buyers are weakening and selling pressure is increasing. The neckline is the support level between the two bottoms. If price breaks below this line, the reversal accelerates. But beware, false breakouts are common. Sometimes price briefly breaks the neckline and then pulls back. That's why confirmation with volume increase, candle close, and other technical indicators is crucial. Stop loss should always be placed just above the neckline. How do we set a target price? In a double top, measure the distance between the peak and the neckline. That difference projects the potential downward move after the neckline breaks. For example, if the first peak is at $20,000 and the neckline at $19,500, the difference is $500. If price breaks the neckline, you'd expect it to fall about $500 lower, towards $19,000. The same logic applies to the double bottom, but in reverse. It forms at the end of a downtrend and signals buyers gaining strength again. The two bottoms are usually at similar levels, but sometimes the second bottom may be slightly higher or lower. If the second bottom is higher, it shows buyers are stepping in earlier, strengthening the bullish case. If the second bottom is lower, it's called a falling double bottom. The pattern is still valid, but the bullish strength may be weaker. In a double bottom, the neckline passes through the peak between the two bottoms. When price breaks above this line, the trend reversal is confirmed. The target price is calculated by measuring the distance between the neckline and the bottoms, then projecting it upwards. For example, if the bottom is $19,000 and the neckline $19,500, the difference is $500. A breakout above the neckline suggests price could rise at least to $20,000. In strong market conditions, the rally could go even further. Stop loss in double bottoms is usually placed just below the second bottom. If that level breaks, the pattern is invalidated. The role of volume is a critical factor. In the double bottom, the first dip comes with high volume due to strong selling pressure. On the second dip, selling volume decreases while buying volume increases, signaling a shift. At the neckline breakout, volume should clearly rise, confirming the start of a new uptrend. Double bottoms are considered reliable reversal patterns because large players often enter the market here. But remember, false patterns always exist. In low volume markets or short-term charts, a double bottom may appear, only for price to drop again. Always use a stop loss and look for extra confirmation. Stop loss placement. In a double top, place your stop loss just above the neckline. This protects you against false breakouts. In a double bottom, place it just below the neckline. This shields you from false signals. Risk-reward is calculated by comparing the distance between entry and target to the distance between entry and stop loss. Ratios of 1 to 2 or higher are usually preferred. Possible scenarios. Price breaks the neckline with rising volume, strong reversal signal. Price breaks the neckline with weak volume. Risk of false breakout. Second top surpasses the first. Pattern may fail. Trend continues. If the prior trend was too steep, the double top may be unreliable, needs extra confirmation. In consolidation, sideways markets, patterns often give false signals always seek confirmation. Putting it all together. To maximize results, volume analysis is key to gauging trend strength. Rising volume confirms reversals. Declining volume hints at false breakouts. Momentum indicators help confirm continuation or reversal, while candlestick patterns add extra confidence. Different time frames also matter. Short-term charts. Patterns form faster, but produce more false signals. Long-term charts. Patterns are more reliable, but take longer to play out. In both cases, combining volume and trend analysis is essential. Market psychology is also critical. Traders who rush into positions often fall into false breakouts and panic moves. Discipline and patience are key. Small trends are not always safe. Measuring strength is crucial. Double top and double bottom patterns are powerful tools for spotting reversals. Neckline and volume confirmation are vital. With target and stop-loss strategies, risk-reward ratios, scenario planning, and awareness of market psychology, you can build a disciplined and solid trading strategy. Even a beginner can take safer steps with this knowledge. Discipline, patience, and strategy are the keys to success in the markets. If you enjoyed this video, don't forget to like and subscribe. See you next time.